Alright guys, welcome back to the channel. Thanks for tuning in. Today we're going to go over Perpetual Protocol and what they are looking to do and how they're changing the game. Guys, it's a really cool project. I've been researching it for a while. I've been looking at it. It's awesome. So basically what they're looking to do, or allowing you to do, is to trade options or future contracts. So if you guys don't know what that is, I'll play a video in a few minutes, or maybe 1 minute, so you guys can understand it. But if you guys are new to the channel, here we talk about different cryptocurrencies and explain them to you to help you understand them a little better. And also, if you guys are new to the channel, go ahead and hit that subscribe button. That way you get notified every time we make a new video, and hit the like button if you like the video, and if you dislike it, go ahead and hit that dislike button. So Perpetual Protocol, this is on CoinGecko. It recently just did a nice pump. It had about 143% in 7 days. It actually came from, well, actually fully came from as low as 66 cents to all-time high of 566. So it's kind of bouncing around there. But really what I want to hit on is I haven't seen any other projects doing anything like this. So I've seen other projects trading like on stocks and on different things, like you can just trade them like wrapped ETH or wrapped Bitcoin. But this one's actually trading options. So if you don't know what an option is, here's the video.
Now that you understand why options exist, I'm going to show you ways you can trade options to make a profit. So most of your favorite companies that you use every day have stock options, and you can trade them right from your computer, cell phone, or tablet. There are two types of options. There are calls and puts. If you buy call, you want the stock to go up. If you buy put, you want the stock to go down. Now, since there are two sides to every market, you can also do the opposite, where you would sell the option as an opening trade and hopefully buy it back at a lower price as a closing trade. This will make more sense in a second. Option prices are based on three elements of its underlying stock. The first one is time to expiration. In the last video, we talked about how options are basically insurance, and of course you pay money for this insurance. Now, the thing about insurance is you don't just get to pay a one-time payment and have insurance forever. You have to pay month after month to keep your insurance. So the longer you have it, the more money you'll have to pay. Options are the same way. They have expiration dates for the exact same reason you have to pay monthly for car insurance. An option with 60 days until expiration might cost $500 when the option with only 30 days to expiration only costs $250. So more time equals more money. So naturally, as time passes, an option's time value will decay. This is known as time decay. Now, let's take a look at how an option's time value will decay over time. The curve will look something like this. As you can see, time decay isn't linear, it's exponential, meaning that as you get closer to expiration, time decay will rapidly speed up. The important thing for you to understand right now is that an option's time value is always decaying, 100% of the time, every day, every hour. This can be your worst enemy if you trade options the wrong way, or it can be a huge advantage if you trade them correctly, which I'll show you in the next few videos. Most stocks have options with weekly, monthly, and quarterly expirations, and you can choose whatever expiration you want to trade in. And in some of my other videos, I talk about the best expiration that provides the lowest risk and the highest returns, so be sure to check those out. So the second factor that goes into option pricing is the price of the underlying stock itself. For each stock, there are multiple options at different price increments. These are called the option's strike price. The strike price is the predetermined price at which the shares of stock will be exchanged if the option is exercised. For example, if you own the stock at $125 per share, you could buy the 125 put because that's where you could sell your shares in case the stock goes lower and you need to exercise your option. So again, the strike price is simply the price that the shares of stock will be exchanged if the option is exercised. Of course, you don't have to own shares of stock to trade options, but the strike price of the option you're trading has a huge effect on what the option's price will be. Let me explain. Let's say the current stock price is $125 per share. For call options, any option that has a strike price above the current stock price is referred to as out of the money. If the strike price is below the stock's price, it is referred to as in the money. And for put options, it's the exact opposite. I know this is a lot to digest right now, but soon it will become second nature. So here's an idea of what each option's price will look like with, let's say, 30 days to expiration. And just a quick note, each option contract represents 100 shares of stock. So these prices have a multiplier of 100. So, for example, if you buy one contract of the 125 call, this will actually cost you $500, not $5. So here's the thing, all out-of-the-money options have no value at expiration. Let me repeat, if an option is out of the money at the expiration date, it will be worthless. So if they won't have any value at the expiration, then why do they have value now? Because stock prices move, and there's a chance that the out-of-the-money options could become in the money if there is still time left to expiration. Now you can see that the further out of the money an option is, the cheaper it is. That's because the likelihood of it being of any value is less than an option that is closer to the stock price, right? Because, for example, this stock is more likely to get to 130 than it is to 135. And as stock prices move on a day-to-day basis, the option prices will also move. If the stock goes up, the calls will become more expensive, and the puts will become cheaper, and vice versa. Now, a common misconception is that you have to hold your position until the expiration. This isn't true. If you buy a call option today that expires in 30 days, and the stock goes up overnight and your call option is now worth $100 more than it was when you bought it, you can sell it for a profit. The expiration date of 30 days does not mean that you have to hold the position that long. Now, you see the prices of these options with 30 days left until expiration. Let's take a look at what these option prices will look like with 0 days left. You can see all out-of-the-money options are worthless, and the in-the-money options are worth the difference between the stock and the strike price. This is because since there is no time left, there is no time value left on these options. This is also referred to as extrinsic value. The third and final factor that goes into option pricing is volatility. Volatility is referred to as the magnitude of a stock's price swings. Higher volatility means bigger price swings and ultimately more risk for the investor who owns stock. Since there's more risk involved, options will be more expensive. Why would the option seller not demand more money if they're taking more risk? Let me explain. I know you're probably sick of the insurance analogy by now, but let's say you are providing life insurance for two different people. The first person is overweight, smokes a pack a day, and has a medical condition. And the second person is healthy, exercises regularly, and has no signs of any life-threatening medical conditions. Now, who do you think will have to pay more for life insurance? Exactly, the person who is at more risk of dying. Now think of this person as a stock with high volatility, and this one as a stock with low volatility. Now, different stocks have different volatilities, but volatility is something that moves around. A stock with low volatility now might have high volatility in the future. Volatility is much more predictable than stock prices, so if you're trading options, it's important to position yourself on the right side of volatility.
All right, so I hope you guys like that video. I'm going to go ahead and break Perpetual Protocol down so you guys can understand it a little bit. What is different between this and options is that instead of having like a longer time frame, these options expire every day. And you can do this on 20x leverage. So normal options, you don't have that option to do leverage. You have an option of going long or short and a asset, or depending on what you're doing. So say for example, hey, I think Tesla's going to go up, so I'll bet it's going to go long. That's what options are. You aren't actually buying the stock, but you are betting that it'll go up or down. So Perpetual Protocol has two parts. It has the traders and the stakers. The stakers are basically the guys who hold the tokens, and here's why you should hold the token. This is a little visual they have, but basically you have the traders. They trade in USDC, not Tether, thank goodness. Then you have the virtual AMM, and then you have the transaction pools and the insurance fund. So these traders, they pay a transaction fee. It's really cheap. It's not crazy money. The good thing about this protocol is it's built on xDai. If you guys don't know what xDai is, I did make a video on xDai so you can understand it, but it's basically an Ethereum sidechain. And basically the fees are crazy. It's like nothing. 286 million in volume per week. This was just tweeted yesterday. I mean, this project's taking off. People are noticing it, and it's definitely going up in price. I mean, look, it already went up 173%. Its market cap is only 101 million, so it does have a lot of room for growth. Not financial advice, guys. This is just my opinion on the project. Let's go back to what I was talking about. So the reason why they have the insurance fund, because 50% of the transaction fees are going to the fund and 50% to the transaction fee pool. So when the stakers are staking, they get 50% of the total transaction fees, and obviously 50% is going into the insurance fund for a black swan event, or if something does happen, and the insurance fund will cover that. The transaction fees pool will go to the stakers. So if you stake 10% of the total token supply, you get 10% of the fees. So that's basically how it works. This is the project's vision is basically creating the world's best, most accurate, and most secure decentralized derivatives trading platform. So there are other derivative trading platforms, but this one actually trades on not option, well, perpetuals is what they call it, which is Perpetual Protocol. And they're different from options because they expire every day or each day. You can look up a couple of videos or interviews with Yin Feng. I probably fudged it really bad, but they used Chainlink. He had a really good interview with one of the members over at Chainlink and explaining it. Chainlink is the oracle that they use. Chainlink is also a pretty good project. Here's some of the key features that set it apart is 10x leverage, quick setup and withdrawals. So this is different from others. So the newest one that came out, you guys have probably heard about it. It's called ZK Swap. But the problem with it is you can have the transactions go through or withdraw off of it, but sometimes depending on how the congestion is, it could be a couple of hours and how many trades are made for it to finally go from layer 2 back to Ethereum with layer 1. You do still have to pay that initial, I'll show you guys a video on how that works. You'll still have to pay that Ethereum initial and the Ethereum gas fee for taking it from Uniswap, getting onto the Perpetual Protocol trading platform. But it's also similar to DYDX. But DYDX is only cryptos. So this one allows you to do any asset. So yeah, you can do cryptos, other ERC20s, but look, they have unlimited potential. So this could be Tesla. It could also be betting on, hey, gold, silver, oil, anything. I mean, it even says it on their website. If you look at the top, it says gold, crude, oil, every asset. Another feature they have is providing lower slippage, and how they do this is basically a algorithmic. I'm sorry, you guys can see the word, I can't pronounce it. Algorithmically, I fudged that so bad, but it provides lower slippage to traders. And how it does this is, say for example, you have a lot of people calling longs and not a lot of people calling shorts. Well, it'll increase the bounty, or not. Well, yeah, bounty is a good word for it. It'll increase the bounty on the other side. So it'll say, okay, well, it's just like in the money, out of the money. It's higher risk, so you get a greater reward if you're right on it. So that's how I can level that out.
How to trade on Perpetual Protocol. The first step will be to connect your wallet. Currently, only Metamask is supported. So right now, we've got no funds available for trading, but we do have $500 in our wallet, so let's go ahead and deposit here. You can enter the max, or in this case, we'll enter 100. There are a few different steps, but this process will allow us to trade with zero gas fees thanks to the xDai network. So let's deposit to move the funds to the xDai network. This costs a little bit more, especially when gas fees are high. We've sped this up a little bit. All right, so now we'll approve the use of the funds on the xDai network. And we're done. All right, so now you can see that the funds are available and ready to trade. Next step will be to choose which trading pair you want to use. Let's go with ETH for now. All right, so you can enter a position size directly in ETH, or you can enter the collateral directly. And next, let's set a leverage. Adjusting the leverage will change the position size, as you can see above. And it could be that when you adjust the leverage after setting a collateral, it might exceed the amount of funds you have. So you can use the max button to just change that if you want. It actually looks like price of ETH has gone up all day. Let's bet it's going to go down, so we'll short. Just sign that transaction. And you'll notice there's no fees for this. And after a minute, our position will appear. Now you can see that the leverage is about the size that we chose. It could vary a little bit depending on market conditions. And after some time, you'll want to close the position to realize any P&L that you've earned. So we'll go ahead and close this. Now you can set a slippage tolerance if you want, review the summary. You'll notice again, no gas fees. And after a few seconds, the position will disappear. And in the trading summary, you can see the trades that you've made in the past. Finally, if you'd like to move your funds back to the Ethereum network, you can use the withdraw function. In this case, there are no gas fees. However, xDai does charge an exit fee for using the bridge, which is 0.05%. So go ahead and sign that. You won't be charged any gas fees. It could take a minute or two depending on the network congestion on Ethereum. And you're done. So you'll notice now that the balance has gone back to zero and the funds have returned to your wallet. Thanks for watching.
So a lot of people are like, oh, well, if I stake my tokens on there, well, what about impermanent loss? Well, this is pretty cool. What they use is Balancer. Balancer is able to add in a couple, if you aren't familiar with it, they take several different assets and dilute the, I guess you can say dilute the risk instead of just into one asset. It goes into several different assets. So here's an example of providing on Uniswap or any other trading platform 50-50. You can see there's a greater risk of impermanent loss because if one token explodes, and obviously USDC isn't going to explode, it's staying stable, then when you withdraw it and it exploded, you're going to get less tokens. But if you use more than just one asset and do several different assets and have it at a 80-20 ratio, then it's going to be less of an impermanent loss than the same thing on the 95.5, which is, it's great. So Balancer allows you to do up to 8 assets, and that's how Balancer is able to do it. And this is what they do on the protocol. So hours since the start of it, they decrease the amount of perp in there and increase the amount of USDC, which settles that off. Here's the token distribution. This is in comparison to other ones. You guys can see it's pretty fair. It's not out of reason. You can see like the team and advisors, they have about a quarter of it. That's the same with comp, same with Balancer. It's the same with MTV, or with MTA, UMA, and 1inch. So it's pretty similar. Well, actually, I'm sorry, UMA is not similar. UMA has about 50%, which is pretty high. So it's not like the advisors are just going to say, oh, great, our token's crazy expensive, so now let's sell out. So you can kind of see the token release. Obviously, the yellow is representing the investor. So maybe when the tokens get released enough, they would drop some of the tokens on the market to pull some off the table, obviously, because, well, they are investors, and if you lose your principal, well, you're going to be losing money. Play with the house's money. And this is also a pie distribution, so you guys can see it. So the use cases, again, is for governance and staking. We explained kind of how the staking works with the... So right now, here was a tweet. This was on January 15th. They had 229 traders generating 495 million in total transaction volume, which is 495K of fees. Those fees, which is 0.1%, they are going right now into the insurance pool. Well, for a Black Swan event, this is still a young project. This is a ERC20 token, guys. They are functioning on the xDai second layer solution in order to provide a better user experience by getting rid of those trading fees, which is really nice. And you guys can see the initial circulating supply of perp tokens with the breakdown. We already explained this a bit, but I'll go ahead and go over it again. Here's the 5 things stakers need to be aware of if you want to. An epoch does last 7 days. So to withdraw the perp at the current end of the epoch, you must submit a transaction to unstake your tokens in the present. Perp tokers can start taking the perp tokens at any time during an epoch, but the staking incentives are time weighted. So if you go half the week, you'll get that half. So it's obviously prorated. You don't just get a full week of what it is. Transaction fees are claimable right after the epoch. So as soon as it ends, you can claim the staking rewards, but they are locked for a 3 to 6 month period. This in mind, if you're wanting to get or unstake, when you unstake in the present epoch, their stake perp or your stake perp will be rolled out to the next epoch. So it's not instant. Here's the risks of staking. You don't have the exposure to impermanent loss. We explained to you they use the balancer, which is really nice. It helps for that. And a lot of projects do suffer from impermanent loss, and it's definitely a huge problem. If you don't understand how it is, check it out. Just Google a couple videos on what a permanent loss is, and changes how easy or changes the way you think about staking. Also, this is another huge thing going for the project. You guys can see options just in regular stocks and whatnot. That 21.9 billion contracts just in the first half of 2020. That's only the first half, and that's just contracts. That's not the dollar volume. Now you guys are like, well, just trade options on stocks instead of on Perpetual Protocol. Well, the reason why some traders would like the Perpetual Protocol is they can use leverage. I really don't recommend leverage. I would never use leverage. It's very risky, guys, because no one knows what that price is going to do from 10 seconds from now, a minute from now, a day from now, or 3 hours from now. No one knows what it's going to do. Leverage is not a good thing, but traders don't understand that, and people like to gamble, and gambling is huge. Hence, a lot of people will be on the project. Also, this is why it's different from other stocks, is because, well, you can have people who front run your trades because there's people behind the back door or on the back end who can see what you're trading. However, on the Perpetual Protocol, it's decentralized and it's just running on its own. So that's a perk for the project. So here's a couple of their investors. They have Alameda Research, Binance, Mechanism Capital, 3 Arrows Capital, Multicoin Capital. You guys can read them. I don't need to read them to you. But yeah, this is the project mainly in a nutshell. What is Perpetual Protocol? You guys can get this on Uniswap. You can get it on Balancer. You can get it on a couple of smaller exchanges too. BKX, MXC, it's a Chinese exchange, and AEX. So, guys, that's Perpetual Protocol in a nutshell, what they're looking to do. Hope you guys liked the video. And if you guys liked it, go ahead and smash that like button. Would like to get 20 likes on this video. If you guys are new to the channel, go ahead and subscribe. That way you guys get notified every time we make new videos. Thanks for tuning in, guys. We'll see you in the next one. And of course, guys, the most important part of the video, our wisdom one-liner, Proverbs chapter 26, verses 22. The words of gossip are like choice morsels. They go down to the inmost parts. I understand the concept of sticks and stones hurts my bones, but words won't hurt me. But guys, words really do hurt. Just make sure if you're going to say something, make sure it's true. And it's never good to gossip about others because there's always birds hanging around or other people hanging around. And wherever it's spoken, it flies around and somehow it goes places. Thanks for watching, guys. If you guys are new to the channel, go ahead and hit that like and subscribe button and hit that bell notification. That way you guys can be ahead of the game every time we make a new video. If you guys are new to cryptocurrency, don't know where to get started, don't know what to invest in, well, participate in the triple threat. The first thing, set up a Celsius account. This is for your savings. This is where you're going to store your cryptocurrency and you can earn interest. It can be up to 5%, 6%, 10%, and they even have some as high as 17%. Here's a referral link. Use this referral link in order to get 20 bucks in free Bitcoin. Part 2 of the triple threat is to get a crypto.com. Crypto.com account is one of the best places, especially for a beginner, to buy cryptocurrencies or smaller altcoins. So now you have a savings account. Now you need to get a cryptocurrency wallet that allows you to buy those smaller altcoins like your Engine coin, your Raven coin, just like smaller alts, so you guys can participate in those big plays. My referral code is down here. If you use this, you'll get 25 bucks free. And the next one is Voyager. Voyager is awesome. There's a list of different cryptocurrencies you can use. What I like about Voyager in particular is you can actually make your next level up in buying cryptocurrencies. You can actually buy Bitcoin with a limit order. So you just hit buy Bitcoin, hit limit, and you type in how much you want. Boom, you're off to the races. So you don't have to watch it and make sure it's a good buy-in. Here's a referral code you guys can use to get some free cryptocurrency. This will allow you to get $25 for free. Can't beat free. And then obviously this is just a fun one, so you can get free cryptocurrency is going on Lolly. You get a daily stack. All you do is you tap the treasure chest and you get free sats. And it's literally free. One of the days I literally got 20 bucks in free Bitcoin. Look, 101,000 sats. Pretty cool.